Hello and welcome to the Tax Roundup for September. Parliament is sitting in all those bills with those budget measures and starting to flow through the Parliament. So far we have the bills introducing the corporate tax rate reduction and small business entity threshold changes, the personal income tax threshold changes, progressive increases to the tobacco excise, and a broad series of measures in an omnibus bill that tinker with various thresholds, indexation and income tests. But this bill also introduces changes to the R&D tax offset. But also introduced to Parliament is the series of social services measures that were blocked by the last Senate as well. They've been reintroduced. It'll be interesting to see whether those bills progress through Parliament or whether it's just wishful thinking on the government's behalf. But inside the Tax Roundup this month, we're going to take a look at new practice companion guide on the taxation of retirement village operators. We're going to look at the GST and barter scheme arrangements and when is GST actually liable on those arrangements. A quick look at multinationals and a new tax transparency code to try and keep everybody honest. But first up, Michael is going to take you through the tax treatment of payments to injured workers. Across to you, Michael.
Now this month we're looking at TD 2016 D1, which looks at the tax treatment of payments made in a lump sum to a worker who's been injured at work. Now this TD refers to some specific legislation in South Australia, but really the principles should apply across Australia and in a number of other situations where you have injured workers who are entitled to receive payments and that payment stream effectively is converted into a lump sum payment. Basically what happens in these cases is someone is injured at work, they're entitled to receive ongoing weekly payments, presumably until they recover from that injury. But in some instances, there's an option to, rather than continue to receive those ongoing weekly payments, they can actually receive a lump sum payment now, and that basically replaces that ongoing income stream. The ATO confirms that that lump sum payment is assessable on revenue account as ordinary income. The fact that it is paid as a lump sum payment doesn't change the character of the payment. Effectively, the worker is being paid or compensated for lost income. And general principle is that amounts received in compensation for lost income take on the same character as the income that was lost. So basically the ATO is saying in a case like that, the fact that it's a lump sum payment doesn't mean it's a capital payment. It's still compensation for lost income. Now, one of the aspects that's interesting about this TD is the ATO recognises that this actually conflicts with a number of private rulings that have been issued to taxpayers over a period of time. So the ATO has said that if you receive a payment like this ruling, or the principles in this ruling, will only apply to you from the date the determination is actually finalised. So the ATO is not seeking to disturb treatment from previous transactions or previous arrangements where, for example, someone's had a private ruling saying that those payments were capital in nature. The ATO recognises that I guess there might have been a little bit of confusion about how things like this should be taxed, but certainly the ATO is trying to set things straight going forward to say that things like this should be taxed on revenue account as ordinary income. What you still need to be a little bit careful about is where a payment looks a bit like this but is actually compensation for the loss of earning capacity. In that case, it may well be a capital type payment. The tax treatment could be quite different. You could be into the CGT rules, and there are some CGT exemptions that can potentially apply in that case. So you still need to be very careful to identify exactly what the payment relates to. Is it compensation for lost income, or is it compensation for loss of earning capacity? Because the two things can be taxed quite differently.
Now across to Rae for PCG 2016-15 on the taxation treatment of retirement village operators.
For retirement village operators, when they make capital growth payments to either a departing resident or their representative, those have been viewed by the tax office as being on capital account for a long time. However, following some cases that happened in 2014, the ATO changed their guidance to retirement village operators on this, and they've recently issued a PCG which explains this. So those retirement village operators now have two options. Either they go on as normal and still view them as capital account, or they can take a look and saying these are deductible now because the ATO said so we can go back and we can amend those returns and we can claim a deduction for those capital growth payments that have been made. Now obviously if they do so, they'd have to also adjust the cost base of those units because those capital growth payments would have previously been included in the cost base. So they do have two options about what they'd like to do, and once again, if they're out of time, they can actually go and ask the Commissioner for the opportunity to amend those tax return late in accordance with the PSLA, which provides the guidance in that area.
In cases, Michael's going to take you through the outcome of the case on the timing of GST and barter scheme arrangements.
The case we're looking at this month is Taxology and the Commissioner, which was an AAT case dealing with the timing of GST liabilities. Now, basically what happened in this case was the taxpayer provided services in the ordinary course of its business. It was also a member of a trade barter scheme. And basically what would happen is that where the company was providing services to other members of the same scheme, rather than getting paid cash for their services, they would just receive credits in their trade account under the barter arrangement. They could then use those credits to effectively acquire services or goods from other members of the scheme. The issue here was, at what point was the GST liability triggered when this business provided services to other members of the scheme? The taxpayer argued that there shouldn't be a GST liability triggered at the time they provide the services and receive their trade credits. There should only be a GST liability at some future point in time, for example, when they actually utilise those trade credits to acquire other goods and services. The taxpayer was basically arguing they were on a cash basis, so they should not be liable for GST until consideration was received. They were seeking to argue that those trade credits weren't really consideration, effectively not until they had spent those credits and actually got some other benefit from them. Now, the Commissioner disagreed with that view. It was originally a private ruling application. It went to the AAT, and the AAT found for the Commissioner's view effectively. The AAT said consideration for GST purposes includes monetary and non-monetary consideration. In this case, the credits, they had value, they could be swapped for other goods and services. So once the credits were earned, credited to the account, that was the time when the consideration was received for the services that had been provided. So receiving the credits into the account was consideration, and that triggered the GST liability for this taxpayer who was accounting for GST on a cash basis. Now, that outcome is consistent with what the ATO has said before. There's a GST ruling that actually deals with a case like that. So it shows that the Commissioner's view on that one is probably the right one. So important just to recognise that consideration can take many different forms. It can be monetary, it can be non-monetary as well. In this case, those trade credits were consideration. That was the thing that triggered the GST liability.
Multinationals have been in the news a lot lately, and Rae is going to take you through the new tax transparency code to try and keep everybody honest.
As we know, large multinationals are under focus and scrutiny in relation to their tax compliance obligations, and everybody wants to make sure they get their fair share of the tax pie. Australia is no different with that. So now we have a voluntary tax transparency code where those large multinationals with a relevant turnover over $100 million are going to be encouraged to voluntarily comply with the tax transparency code, whereby they would provide information in relation to how they are managing their tax affairs. This information would be hosted by the ATO and would be available to key stakeholders. But once again, the ATO said they're not responsible for the reports and the information. They're just there to make it available. So hopefully everybody feels a little bit more reassured about those companies paying their fair share of tax in Australia.
And that's the tax roundup for this month. With such a level of change, don't forget you have access to the Knowledge Shop membership if you're a member of Knowledge Shop, but also our array of training programs, both webinar and face-to-face. Just go to knowledgeshop.com.au and see what's on offer. And don't forget to keep on top of all those legislative changes. Just take a look at our Twitter feed at Knowledge Shop AU. See you next month.